Okay, welcome everyone to the 2016 MyNetPhone full year results presentation. Thank you very much for your time. I have with me today Matt Jepp, my CFO, who will be joining me on the call and helping answer some of the questions as we go along. I'll start with a bit of a corporate intro. I know a lot of you have seen me present before and have been following us for some time, but there's always some new people. So we will go through, I guess, the overview and then get into the financials and then into a bit of the future. So in terms of MNF Group, we're a global voice communications specialist. So this chart sort of shows you the mind map of our business and how we're going. So we're a global voice communications specialist. In terms of customers, we operate across different market segments. We, of course, operate in the mum and dad consumer market, the business enterprise and government market, and the carrier service provider market or wholesale market, and, of course, next generation providers, which I guess are the future of voice communications. To give you some quick stats, in terms of consumer residential, we have 110,000 subscribers, of which 91,000 voice, 13,500 data and 5,500 mobile. In terms of business, enterprise and government, we have about 10,500 customers, of which 8,500 are voice, and included in that are 3,200 virtual PBX, which is one of our key products, as well as 2,000 data customers. In terms of wholesale, the Symbio business in Australia is currently operating 238 unique wholesale customers, of which 63 are on the iBoss platform. And the TNZI global business is operating 237 wholesale customers. So I guess you could say Symbio's winning the race by one, Matt.
For the moment.
For the moment. In terms of some other exciting stats, we currently have 2.7 million phone numbers hosted on the network here in Australia. Our number of numbers ported into us is sitting at just over 500,000 ported numbers, which is great. We have about 350,000 VoIP endpoints on our network and 7,500 SIP trunks. So we're getting some pretty big numbers. And I guess there's a lot of ongoing growth. So with regards to people, we have 250 people in the organisation, of which 200 in Australia and 40 in New Zealand, as well as a few in the UK and the US in technical and sales roles. With the people, we create innovations, which in the forms of software and also intelligent network. With the software and intelligent network combined, we create a bunch of products which allow voice communications across all segments of the communications industry. That gives us a very diversified voice products portfolio, which we sell through different brands in the business. In terms of what's happening in industry, as you all know, there's been a huge amount of consolidation in our industry. The big players have been relentlessly buying up the middle-sized players. The result is that they've sucked the middle out of the industry here in Australia and left only a few mid-sized telcos, like, for example, MyNetPhone. In the mid-market today, we really only have MNF Group, we have Speedcast, Macquarie, Amaysim and Big Air, and there's really not much else in the ASX mid-cap telco sector. Below us, of course, there's a plethora of smaller providers, either resellers or application providers, or global players who've got a small footprint in Australia and New Zealand. In the end, all this market consolidation has been really beneficial for us as a company, because we have the network, the systems and the products and the capabilities to, I guess, step up into this mid-market space. The big players have shown that they really are only driven and motivated by their retail brands. After all, why would they support their competitors? MNF has found itself in a position to be able to fit in between the big players and the smaller ones and provide aggregation and value-added services in both wholesale and enterprise. Going on to slide 6, here's another view. A lot of these brands you might have known have all been swallowed up. Even if the brand is still trading today, it's now become part of a larger oligopoly, which is the Australian telco industry. We have to be cautious, of course, putting MNF logo up next to these big guys. We sort of want to elevate ourselves to their level to show that we are a serious, credible challenger. But we also need to be careful not to be classified as the same as them. So why invest in the MNF Group? Well, as I said, I see ourselves as a credible player in a big market. So we've come a long way over the last 12 years, and I think we've still got a long way to go in terms of market share, in terms of product innovation, and even moving into new markets and growing with our customers. So there's a huge market out there. We've got a fantastic future-proof voice network. We've built it from the ground up. It's proving to be very high quality, very stable, very robust. Not making any comments about any other Tier 1 telcos in this country, but our customers are very satisfied with the quality they're getting on our voice network. We also have a very diversified voice services portfolio, and that's diversification in terms of market segment. It's now diversified in terms of geographic segment, and of course it's diversified in terms of the value add that we provide through the various products inside each one of those segments. So that's quite a robust business, but even though it's so diversified, we still specialise on voice, which I think is quite unique, that we can be diversified but also focused at the same time. We of course have a lot of our own intellectual property. We develop a lot of software in-house. We have been doing so ever since we started the business, and our software team is one of the fastest growing parts of our business. And we've demonstrated consistent EBITDA growth, and now recently with the TNZI acquisition we have global growth potential. Moving on to slide 8, here's our updated MNF Group Global Network, which those of you with a keen eye will notice there's some additional links between Hong Kong and London and Hong Kong and Los Angeles, thanks to the Hong Kong POP upgrade which we're currently undergoing. We expect Hong Kong, after a few delays, to be ready for service later in September. Of course, we've upgraded Los Angeles and customer migration is about to commence, and earlier this year we upgraded the UK and customer migration there is almost complete. The next cab off the rank, of course, is the New Zealand network upgrade and the TNZI Australian POP consolidation, as well as potential roadmap for Singapore and other market expansion. In the domestic network, of course, this is the foundation of our business. The Australian network is a very high quality, resilient network, and it has not missed a beat. Of course, I mentioned earlier the New Zealand network upgrade, which is more of a consolidation between the TNZI network for cost reduction, as well as a Symbio expansion into New Zealand. Okay, so this chart shows you our product mix, and we've worked really hard with this result to be more open and transparent and more consistent with the way we're describing the business, so you guys can try and see a bit more of what's happening under the bonnet. You've got to appreciate it's a balancing act for us. We don't want to sort of open the kimono too wide and let our competitors see exactly what's happening, but at the same time we want to make sure our investors are comfortable with the way the different parts of the business are going. So this chart really outlines the structure of the segmentation. We've divided the business into 3 very clear segments: Australian domestic retail, Australian and New Zealand domestic wholesale, and global wholesale. So in the Australian domestic retail, of course, we operate brands like the MyNetPhone brand and Connexus brand and a couple of other minor brands which we acquired, and we offer a complete range of product directly to consumer for residential, small business and government. Those products include SIP trunking, our virtual PBX, which is a fantastic product, business internet services, toll-free numbers, number portability, audio conferencing, as well as our home internet and VoIP home plans for consumers. So that's the retail products segment. In the Australian New Zealand wholesale segment, we also operate SIP trunking, which is more for service provider, high capacity connections for service providers. We offer pre-select, call termination, inbound number porting and virtual numbers, co-location and data feeds for analytics, and then under the iBoss product we have wholesale aggregation, data enablement and MVNO. Then the last segment is the global wholesale segment, of course, where we have TNZI, the recent acquisition, and their main product is of course voice carriage and toll-free services. ITFS, sorry, is an acronym for toll-free. You'll notice that we've now got the Symbio logo under the global wholesale segment, and that demonstrates that we are actively working to increase the product mix for global wholesale. And the first product that we're marketing globally is the inbound and virtual numbers product. But more importantly, what we've done in organising the segmentation is we've taken some pre-existing Symbio customers that were domiciled globally, so in other words they had their headquarters and their operations outside of Australia but were buying from us. We've segmented them now under global wholesale, and that is part of the strategy to grow those customers. We want to service them as a global customer, so we've actually transitioned their account management to the TNZI team in Wellington, and we're now focusing on growing those customers not just in Australia and New Zealand but the rest of the world, or specifically Asia Pacific. So we've already shifted some customers over and we're focusing on growing those customers. That's why Symbio's logo is down there. And of course we have a couple of other products, TollShield and the OCA Soft Switch, which provide other software value-added services. So that's basically the full product mix in a nutshell. And as I said, that segmentation now will be consistent through this report and the director's report. So if you've got any questions or thoughts of what's in where, come back to this chart and check it out. Moving on to slide 11, it's with great pride that I can announce to all of you that we've won a whole swag full of awards this year, and we're only halfway through the calendar year. All these awards are of course for our in-house developed software and intellectual property. We've been recognised by the Australian Internet Industry Association for the Infrastructure and Platform Innovation Award and the Business Solutions Award, both awards given for our new TollShield product. We've also been awarded the Antil Smart 100 Awards for both TollShield and iBoss. And finally, we've been awarded the Big Crystal, the ACOM's Innovation Award for Emerging Enterprise for TollShield. We've finally broken through the Australian telco mafia and been recognised by our peers. So moving on to slide 13, our revenue this year is up to 161 million, which is thanks to the full year of the TNZI acquisition. Gross profit is up 48.6 million, and of course gross profit for us is more of a critical indicator of our success than revenue. We're more of a gross profit company given that revenue can vary so much with our minutes trading business. EBITDA of course is very important, and we're up 46% this year to 17.8 million, which is just slightly ahead of forecast, about 3% ahead of forecast. And most importantly, NPAT up to 9 million, up 25% on last year, which is a whole 7% above our original forecast. Our earnings per share are at about 13.5 cents per share this year, and the growth in EPS is slightly behind NPAT due to the dilution of the placement we did earlier in July. Our dividends per share are up to 7 cents per share, which is about 52% of our EPS, which is consistent with our long-term dividends policy, and of course the dividends are fully franked. Okay, in terms of getting into some more detail, certainly the revenue there, you can see the growth, and that, as I mentioned, is largely due to a full 12 month contribution from TNZI with 1 month of US contribution. So for FY17 we expect to get 12 months of US contribution. The US revenue is only around about 2.5 million per month, so it's not huge, but it certainly will top up the revenue going forward. The largest organic growth was the domestic wholesale segment, and I'll talk a lot more in detail about that. In terms of gross margin this year increased 53% on the previous year, and all segments made a very strong contribution, in particular the domestic wholesale segment showing the biggest organic growth, which is very important. We'll talk more about that later. In terms of EBITDA, 17.8 million, an increase of 46% on last year, slightly ahead of expectation. So moving on to slide 15, as I mentioned earlier, our NPAT is up to 9 million this year, which increased 21% on the previous period, and it's a pleasing result, which is 7% above NPAT. On a compound annual growth basis, that's 23.8% compound growth over the last 5 years, which is pretty impressive. On the dividend side, we're at 7 cents, which is half of the EPS at 13.5 cents, which is consistent once again with our dividend policy. This is probably one of the most exciting slides in the slide deck. It's the first segment gross margin and per segment revenue. Now, there's quite a lot of explaining to do to make sure you guys understand this correctly, and all this information is much more explicitly outlined in detail in the director's report. So if you do get a couple of strong cups of coffee and download that report and read it by the fire tonight. But in terms of domestic retail, as we mentioned, that segment is steady. I have some more charts later on in the presentation explaining a couple of the moving parts inside domestic retail, but let me just give you a bit of an overview here. There's 3 major sub-segments in domestic retail. There's the retail, consumer, home, phone, home internet. There's small to medium business, and there's enterprise and government. Now, as we discussed in prior years and also in this result, the consumer VoIP home phone is in decline, and that is really due to the fact that mobiles are becoming the dominant form or the preferred form of communication. So for consumers. So we're sort of seeing a continued decline there. In terms of residential data, we also took a bit of a hit this year, primarily due to the churn event of the NBN. I'll talk more about the NBN later, but we are getting our house in order to address the NBN opportunity, and we've got some good news on that. Small to medium business performed well and grew about 11% on subscriptions in terms of virtual PBX, and it's generally growing in margin. And then, of course, there's government, which is really the star performer in that segment. In terms of the government, of course, Tasmanian government has extended their contract to 2022. We've also won some significant government enterprise business in New South Wales. Unfortunately, I can't name the government enterprise, but that happened in the last quarter of last financial year. So it really only had a minor impact in this result, and we do expect to flow through some results going forward. One piece of news is that in terms of the margin on a quarter-by-quarter basis, the last quarter of last financial year, so Q4 of FY16, we produced actually a record margin under the domestic retail segment. So there is an underlying recovery there as we transition from a very residential focused business into more of a business, enterprise and government retail business. So I know it looks like it's flat, but as I said, underneath that the wheels are moving, and we should see some positive, I'm not going to promise anything at this stage, but we should see some positive movement in the gross margin contribution of that segment going forward, thanks to government business. Moving to the domestic wholesale segment, this is certainly a segment that's very exciting for us. You can see there we had 49% year-on-year organic growth. So it's 100% organic growth, no acquisitions, affected this. This result is due to signing up more carriage service providers to our platforms, and the growth of those carriage service providers once they're on our platform, and of course excellent account management and sales effort by the team. So it's fantastic that it's grown 49% this year, and we look forward to some continuing strong results in that segment going forward as we continue to sign up, focus on what we're doing, which is signing up more customers and growing those customers. Global Wholesale, now don't just look at the graph here, because let me explain it in a bit more detail. The dark blue bar, which represents FY15, includes 4 quarters of the Symbio's global customers. So that's Symbio's pre-TNZI acquisition, so pre-acquisition global customers, which we've put into that segment because, as I said earlier, we want to nurture those customers in a global context and get more global business out of them. So we've actually transitioned their account management and their relationship management to TNZI, and it makes sense because no one wants to buy Hong Kong phone numbers from Australia's leading VoIP provider, right? You want to buy Hong Kong phone numbers from Asia Pacific's leading VoIP provider. So that's sort of the reasoning behind that. So that's why FY15 has that blue bar. That blue bar also has 1 quarter of TNZI, which is the last 3 months of FY15. So it's very hard to compare FY15 to FY16 because FY16 has 4 quarters of Symbio and 4 quarters of TNZI. But the key statistic here in the note underneath the chart says that if we were to do a relative full year margin comparison between FY15 and FY16, we would expect to have seen a 21% year-on-year growth. In other words, had we owned TNZI for the full extent of FY15 and had we done those bar charts like for like, side by side, we would have seen 21% growth. Now, to me that's fantastic because it's the first year since acquisition. We've been flat out doing things like integration, sorting out HR, hiring people, building the network, but just simply by refocusing the people, motivating them correctly, giving them the tools they need, and setting them achievable goals, we've managed to lift that business by 21%. So that's really fantastic to me in terms of what we've done there. I have a question here from Andrew, which is, what's the gross margin differential between the retail consumer versus medium business versus enterprise and government? That's a good question. We've given some breakout in the director's report in terms of subscribers in operation and some of the description of some of the wins we have. We haven't explicitly broken out gross margin per segment, but let me just say that enterprise and government is still very, very small at this stage in terms of gross margin relative to the others. So out of that 15 million that you're seeing in domestic retail, I would say on an estimate basis, government would be about 1 million of that. And then I would say out of the remaining 14 million that residential and small to medium business will be 50-50. That's a rough rule of thumb. And you can sort of work that out by looking at the fact that we've got 100,000 mum and dad customers. We've got 13,000 of them on DSL. You can work out the average revenue per user. And you can sort of work it out that way, and then virtual PBX, it's a higher revenue per user. We've got less customers, but it works out about 50-50 for that once you take away government. So The point there is government's growing very rapidly, but it's growing off a small base. So it's going to take another year or two before that government run rate gets to the point where it really starts swinging the pendulum. However, small to medium business is doing well, and it is roughly equal with residential. So we should see some growth coming out of that segment going forward. Okay, I've got a question here from Claude. The like-for-like for international wholesale is 21% growth for gross margin or for revenue. It's, the growth is for gross margin, yes. So that 21% gross margin is across both the Symbio products which we've transferred to international, as well as the international business we acquired. As it turns out, they both grew by roughly 21%. Yeah, mathematically it just was pure coincidence. And then of course when they combined, it's 21%. So we're seeing good solid growth on the pre-existing Symbio global business, which we've transferred, and the new TNZI global business, which we acquired, and that growth is at the gross margin level. We tend not to focus too much on revenue. We do have a revenue segment chart there because I'm sure everyone wants to sort of see it. But the problem with revenue is it's very variable when you're doing minutes trading business, and it does tend to maybe mask and cloud what's really happening under the hood, whereas gross margin gives you that stability. It's sort of like peeling the husk off the fruit and you can just see what's inside. In terms of cash flow, operating cash flow for the year was 15.5 million, which is just below EBITDA. So that's good. Our tax paid this year is up on previous year. There is some tax back pay and prepayment as well there, so there's a few things, moving parts in that tax number.
That's right. We closed last year with around 1.2 million tax outstanding. We caught that up this year, and we paid pretty much all of our FY16 tax within the year as well, which is why the tax paid is a little bit higher than last year's.
Yeah. In terms of interest, that was of course a little bit higher because of the facility, the acquisition facility we have. Although having said that though, the good news is we've prepaid as much as we can of that facility. So net cash flow is 10 million there. CapEx is 6 million, which is exactly bang on where we forecast it to be in terms of spending 5 million on the global upgrades. And that has paid for the London pop upgrade, the Hong Kong pop upgrade, the LA pop upgrade, as well as the office relocation in Wellington to get out of the Spark building. It's also paid for most of the equipment for the New Zealand upgrade, as well as some upgrades in Australia. So, you know, we've actually done an awful lot in the last 12 months, and we do expect CapEx moving forward for FY17 to be down to 3 million, and that is really to complete the New Zealand network integration, complete the Australian TNZI network integration, and possibly Singapore. And then if CapEx is any higher, it'll probably be driven by customer-led opportunities, which of course we love to keep moving customers. I've got a couple of questions here. One question from Jeremy regarding the progress made on the Dubba deal. Yeah, look, so Dubba is another publicly listed company. They made an announcement. I've got a question from Mark about how many minutes did we sell domestically. I have a feeling we're still tracking at around about the 3 billion per annum. It ebbs and flows up and down, and TNZI is also around about the 3 billion. So gross minutes hasn't increased in either network over the last 12 months. So we'll go to the next slide. So in terms of free cash flow utilisation, we take the free cash flow 4.4 million. We've paid 4.5 in dividends, including this final dividend. We raised 16.5 million in equity. Now that's a combination of the capital raising we did in July last year to fund the CapEx and possible other acquisitions, as well as dividend reinvestment plan and staff options exercise. In terms of acquisitions, we have a $200,000 adjustment due to working capital adjustment to do with the TNZI acquisition. And in terms of debt, we've prepaid 11.6 million in terms of debt, which is the maximum that we can pay at the moment. That's a combination of voluntary and mandatory payments. And then we have the other, which is supply innovation. So linked to the US completion, there are a bunch of suppliers to move over from Spark to us to do with the TNZI business. And the way that these suppliers work is there was basically outstanding debts, which Spark gave us the cash to settle those debts. So there is a matching liability to match that cash. So net it is neutral. Matt's just flicking into what page that is.
Yeah, look, I was just going to make the comment in the prior year, our net liabilities, our debtors less liabilities was around 1 million liability. This year it's around a $40 million liability, and that 40 million is matched pretty much 1-for-1 with the additional cash that we've seen come in to cover those liabilities. So you'll see our trade and other payables on the balance sheet have increased by about 36 million from 29 to 66.6. So that's the reason for that.
Yeah. So it's not free cash, it's really just matching liabilities. Just quickly on the metrics, 67.5 million shares. We closed last Friday at $4.03. So our market cap is $270 odd million. And the final dividend, as we said, is another 3.5 cents on top of the interim dividend. So total dividend is 7 cents fully franked. Okay, so I've got a question here from Luke saying, what's the picture for franking going forward, given more revenue is offshore? Well, there's a couple of aspects to that. One is we've got tons of franking credits at the moment because
4.2 million at the end of June 16.
Yep, because we've been paying our corporate tax. But going forward, it's a valid question, because as the global business starts making more profits offshore, we will have to pay some taxes in other jurisdictions, namely New Zealand, the US, Singapore, and the UK. The good news is, though, that we've a transfer pricing policy which recognises the intellectual property value of the functionality that we're doing. So we're developing that intellectual property in Australia. So that intellectual property belongs to the Australian entity, and we're charging royalties. I guess it's like, fairly standard. We've had official formal advice on this from international tax experts, and the benefit is we will continue to pay tax in Australia, which means that our franking ledger should remain quite healthy, especially if we maintain the 50% of EPS payout ratio. So we don't see any...
Yeah, look, certainly at 4.2 million franking credits at the end of the year, this is not going to be a big challenge for us for a few more years yet, I wouldn't expect.
Yeah, if at all. So just recapping, I guess the last 5-6 years here, you can see our trajectory in terms of EBITDA. And you can see it's a combination of organic and acquisitive growth, done many acquisitions over the last 5-6 years, but we've also had some very good organic wins during that time. So hopefully this gives you a bit of a snapshot back. But we'll move on because we've got plenty more material to cover. In terms of service and operations, so this is giving you a little bit more visibility into the domestic retail sub-segment. As we've discussed earlier, VoIP or voice subscribers are declining due to the mobile convergence that's approaching. Data, DSL and NBN subscribers took a bit of a hit this year, and that's really due to us being a bit slow on getting onto the NBN. The NBN has posed a lot of challenges. I don't know if you guys have seen me in the press discussing how the structure is not really suited to small carriers. We've got lots of challenges in terms of getting access to the 121 points of interconnect. We've got challenges around pricing to do with the carrier virtual charge. So it's been hard for us to get that sorted, and not having the scale of the big four means that our costs have been higher. Now the good news is we have actually managed to implement arrangements for backhaul to all 121 points of interconnect, which really levels the playing field for us, and we're hoping that will really boost our NBN run rate. As it turns out, our residential sales team is already selling more NBN services every month than they are selling DSL services. So we've already seen that flip from traditional copper volumes to NBN volumes. And now with these new commercial arrangements with our backhaul partner, we hope to really be able to get some strides and recover that number. In terms of voice, we're not really actively promoting straight out VoIP anymore because there's just no point competing with mobiles. But we are selling voice and NBN packages, which seem to be selling quite successfully. So we see as we can lift our NBN rate, we will be also able to lift our voice rate, which is great. I got a question here from Mark going back to this global segmentation. How many customers were transferred from Symbio Domestic to the Symbio Global segment? Now, keep in mind they were only transferred from a segmentation reporting perspective, and I actually don't know off the top of my head how many customers, but I would say it's only probably about a dozen or less, and roughly about $6 million of gross margin for FY16 would be my rough estimate of how much gross margin was transferred. The revenue, we don't track revenue that closely, so I wouldn't be able to tell you the revenue number, but that should give you an idea. Okay, so I've got a question here from Luke saying, will 5G and voice over LTE have much of an impact on MNF, additional opportunities or threats? Actually, it's an opportunity. So for those that aren't too technical, 5G is, I guess, the next generation mobile network that people are starting to talk about, and voice over LTE is effectively voice over IP over mobile from a carrier. Now, it's sort of the next generation for mobile telephony. You can tell when you're making a phone call with VoLTE because the voice quality is really clear. It's like 22 kilohertz audio, it's crystal clear. Most of the leading mobile networks around the world are just in the middle of migrating to VoLTE, not necessarily 5G, because VoLTE can be on 4G as well. And that's actually good, especially for the TNZI global business, because it will put more focus on quality. Once you get, we've noticed like things with CLI presentation and with mean opinion score, when people start measuring that as a satisfaction level for their retail customer base, they then tell their buyers to go and buy quality product. So the more VoLTE there is, the more buyers will be looking for quality voice minutes, and of course quality is our middle name. So we operate directly with our carrier partners here in Australia. We connect directly to their mobile networks, and we've already got plans in place for upgrading interconnects in terms of VoLTE. So that will be a good thing for us, a good thing for the industry overall, because it will improve the quality of voice communications. Moving on to slide 22, our services in operation for domestic retail, small to medium business show very pleasing results with our virtual PBX, showing consistent growth year on year of 11%. Keep in mind, virtual PBX is one of our key products and is a key part of our business segment. We now have over 3,250 small businesses using our virtual PBX, and we have a new virtual PBX refresh underway, which we hope to launch before December 2016, which we hope to increase the run rate of virtual PBX sales. You may notice that other voice business is down slightly. However, that's due to reclassification of some inactive services, and there was no negative impact to margin or revenue thanks to that cleaning up. Also, government enterprise sector is growing very, very strongly, and we've had an extension from Tasmanian government extending our government business till 2022. In addition to that, we've recently signed a couple of government enterprises in New South Wales government, which unfortunately I can't name who the enterprises are, but those contracts were signed late in Q3 and Q4 of last financial year, and we expect to show some strong contribution from that in FY17. So certainly looking strong in business, enterprise and government. Quickly on domestic wholesale, once again this is the star performer for this result, 50% gross margin growth in 12 months organically. We added 13% new customers, taking us to 238 unique wholesale customers. These wholesale customers tend to buy more than one product at a time from us, often several products. The other key indicator there is number portability. We increased the numbers ported to us from other carriers by 16% to 502,000 numbers. Great, we've broken through the 500,000. In terms of overall hosted numbers, we are now up to 2.7 million, which is great because that's an increase of about 500,000 from a year ago. So that's about a 20% increase in 12 months of hosted numbers. So these are great numbers. And let me explain how it works. These are wholesale customers that sign up to buy certain capabilities and products from us. So we've signed up 13% additional service providers, which they are going to bring us new revenue, but then the other 211 wholesale providers we had from last year are also generally growing as well. So you get this compounding growth effect where you get the new customers bringing us business and the old customers continue to deliver us business. Moving on to slide 25. In terms of the residential market, the trends are the easiest to pick here. It's clear that more and more consumers are choosing mobile as the platform of choice for the inbound and outbound calling needs and international calls. Australia and New Zealand has definitely become a mobile-first market, meaning the mobile is now the first choice for most people's personal communications. On the broadband side, we of course have the ongoing migration to the national broadband network, and as you probably all know, the issues the industry is having with that. A possible emerging trend will also be the use of your mobile with virtual mobile numbers, and these will emerge through the use of mobile apps providing virtual numbers on your mobile device, as well as identity hiding and other advanced analytics. The good news is my phone's active in all these areas, and our NBN run rate has now increased that of copper. In terms of business telecoms, this is where we're starting to get a bit more exciting. So in terms of trends, my phone's been around 12 years. I've been working in VoIP for longer than that. Really, it's always been, yep, VoIP is the future. This is going to be the year that VoIP makes it big. And I guess in the last 15 years, there's never been a year that VoIP has exploded. But now I think we can see a really clear direction for innovation in voice. Whereas a lot of people have been saying for a long time, oh, voice is dead, it's going to be replaced by social media, it's going to be replaced by this, that, and the other. It's like, well, yeah, that's part of the mix, but don't forget you need any-to-any connectivity. You need the ability to pick up the phone and dial anyone anywhere in the world. That's the unique value of voice telecoms. And that's no more truth in that than in business, because businesses need to be able to reach people, and they need to be able to be reached by people, their customers, even if they're not on the same social media network. Of course, you don't. If you're a plumber, you don't know who your next customer is going to be, so you need to be reachable from the public network. So this any-to-any connectivity is a key aspect that I think is critical to the future of voice, and it's one of the things why phone numbers are so important. What we're seeing in business telecoms is in the past, we all had this premise-based equipment. So we had a box, key station or PBX connected with some ISDN or some PSTN lines, and a lot of Australian businesses still have that. That's great. The more up-to-date businesses are moving into the cloud, and they're moving into things like virtual PBX. Now keep in mind, we launched our virtual PBX product in 2006, 10 years ago, and the product is largely unchanged. We are doing a refresh this year, but if you think about it, we were really market leaders back then. So virtual PBX is basically where the infrastructure is now in our data center, and you just have a handset on your desk at work. There's also, of course, using email, using mobiles and instant messaging. There's sort of a bit of a combination there. Definitely we are seeing people move from premise-based into the cloud. But the next stage beyond that is what I call fully app-based. So that's a new generation of applications which unify, doesn't matter the device, so they unify your mobile, your desktop phone if you want one, your laptop, your computer, and they give you access to any communications application, such as a PBX or a conferencing. They unify your instant messaging with your voice, with your email. It's really amazing, and I can't describe it. I can't do it justice here. I've seen product demos in the US of what's coming around the corner, and honestly, you sit there and you watch the demo and you go, wow, this is going to revolutionize my business, in terms of if I was a small business owner, let alone revolutionize the industry. What I think is going to happen is, as the NBN rolls out over the next 3 years and the NBN gets into metropolitan areas, it's going to force people to get off traditional ISDN and PSTN services, and it's going to force them to upgrade. Some of them will upgrade to virtual PBX because that's the lowest risk, and it looks like a duck, quacks like a duck. It's sort of like the same as what they had before, but just a bit different. But I think a lot will leapfrog straight over virtual PBX into the next generation app-based system. Now, we're seeing a lot of innovation in that space coming from overseas, from Europe and the US. And the good news is that for these guys to innovate, they need our capabilities, which is our voice network and our building blocks. And you can see the Lego blocks there on the slide. And these guys build on top of those Lego blocks and they create new applications. So I think this is very exciting. So we're active, of course, in the virtual PBX space. This is a key part of our business. We're doing SIP trunking as well, and we're also enabling this next generation. Domestic wholesale. Our domestic wholesale business is being fueled by the industry consolidation that I talked about earlier. There's significant opportunity for us to grow into areas like NBN and mobile aggregation with the iBoss product, and we now have 63 iBoss partners in our domestic network. But Australia is also known as a first wave market, so we're got a very solid economy. We've got a bunch of technology adapters in our population, and we like new technology. I mean, iPhone, I think we're the number 2 market for iPhone or something crazy like that. So we're a very proven market for technology deployment. So what happens is people develop applications overseas, and when they finish in their home market, or when they've addressed their home market, they look at overseas markets. Australia and New Zealand tend to be one of the first markets they look at. So we're seeing a whole lot of new applications coming in. And once again, as I mentioned earlier, these need these building blocks that we have here. These legacy integration, the APIs, the virtualized numbers, the number portability, all the regulatory stuff. So we're in a really good position on the domestic wholesale side. And our strategy for FY17 is really to continue to grow aggressively into the wholesale space and become the number 1 wholesale aggregator in Australia and New Zealand. So pretty simple strategy really, but I think we are growing strongly. And of course, there's always going to be competition, there's always going to be alternatives, but I think we've got a really good spot, and I think it's an exciting year ahead. If that wasn't enough excitement for you, then we go to the global market, and what we're seeing here is that the global wholesale market is being driven by the end users in those markets, and our global wholesale carrier customers are looking to provide their end user customers with the experiences and with the products that they're demanding. So all those trends that I talked about earlier, you can translate them globally. Now, typically Australia's the first wave market. They typically then look at Asia as a second or third wave because Asia's a bit harder to do business in, and technology adoption rates lag. But what we are seeing here is that if we can cement the businesses that integrate to our network here in Australia and New Zealand, the strategy is to take them into the Asia Pacific region with the TNZI assets, with the expansion that we're doing, and try and, I guess, get them into the ground floor and grow with those partners. There is a reference to the bottom of that slide to an IDC research paper. It is freely available. If you Google that research paper, it gives you an independent view of what I'm saying, and it discusses, I guess, the opportunity. Now, like any research analyst, they're a bit optimistic, so I think they're a couple of years ahead of themselves in terms of the adoption rates and the market size. However, I guarantee you that the trend has started and it's irreversible. We're not going to go back to copper technology. VoIP is the future. These applications are the future. The ways of using voice are changing. There's no doubt about that. And for us to be successful, we need to deploy our network in as many countries as we can, integrate our software into as many different environments as we can, and have as many partners build software and build applications on top of us, and then basically our job is done. So that's that, and then the last slide on the deck is basically a summary of that in terms of what we're doing to address the domestic and global opportunities, and that is really the end of my presentation. I'd like to thank everyone for their support and I look forward to a great FY17.
Thank you, everyone.
Bye.